IMF 2026 Article IV Consultation, United States. Staff Concluding Statement, February 20th, 2026. The IMF's 2026 Article IV consultation assesses a major policy shift undertaken by U.S. policymakers in 2025. The overarching objective of this shift is to increase economic self-reliance and raise the living standards of American workers. This strategy includes expanding domestic manufacturing, reducing the trade deficit and dependence on foreign goods, increasing domestic energy production, curtailing reliance on unauthorized immigrant labor, shrinking the federal government's footprint in the economy. The IMF's focus is the macroeconomic impact of these policy changes on the U.S., its trading partners, and the broader global economy. Economic performance in 2025, strong but changing. The U.S. economy performed well in 2025. Real GDP grew 2.2% Q4. Growth was driven by strong productivity gains, despite a government shutdown that dampened activity in Q4. PCE inflation was broadly flat, with tariffs pushing up goods prices while services inflation declined. Employment growth slowed significantly, yet the labor market remains near full employment. Unemployment stood at 4.3% in January 2026. Foreign-born labor inflows dropped sharply. Prime-age labor force participation increased. Financial conditions were loose. Equity markets hit record highs, and corporate spreads fell near historic lows. The federal deficit narrowed from 6.3% of GDP in FY 2024 to 5.9% in FY 2025. However, the U.S. external position remained moderately weaker than medium-term fundamentals suggest. Policy impacts going forward. Fiscal policy. The 2025 tax and spending package will add about 0.75% to GDP in 2026-27, increase the deficit by roughly 1.5% of GDP. In IMF terms, tariffs function as a negative supply shock. Immigration. Stricter border enforcement and removals are projected to shrink the foreign-born labor force, slow employment growth, add modest inflationary pressure, lower output by about 0.4% by 2027. Deregulation. The administration is pursuing broad deregulation, a 10-to-1 rule. Eliminate 10 regulations for each new one introduced. Expanded energy development, fossil fuels, geothermal, biofuels, nuclear, hydro. Reduced emphasis on renewables relative to higher carbon sources. Financial regulatory recalibration, a developing framework for digital assets. These reforms may increase dynamism, but the IMF notes it is too early to quantify their macroeconomic impact. The outlook for 2026. Growth projected at 2.4% Q4. Core PCE inflation expected to fall to 2% by early 2027 as tariff effects fade. Risks to near-term growth and inflation are considered balanced. Employment growth is expected at less than half the pre-pandemic pace, but with slower population growth, unemployment should remain near 4%. The IMF has lowered its estimate of medium-term potential growth by 0.25 percentage points due to weaker labor force growth. The current account deficit is expected to settle near 3.5% of GDP, still above pre-pandemic levels. Federal deficits are projected above 6% of GDP, with debt to GDP steadily rising. Risks. Upside risks. Deregulation could stimulate investment. Productivity gains may persist if technology adoption accelerates. Downside risks. Trade uncertainty could weigh on investment. Labor shortages in immigrant-reliant sectors could disrupt output. If technology investments underperform, financial conditions could tighten sharply. Monetary policy. The IMF views the Fed's easing in 2025 as appropriate given slowing job growth and limited second-round tariff effects. Baseline projection. Federal funds rate, 3 to 3.5% by end 2026. Inflation returning to 2%. Full employment restored by early 2027. The Fed has halted balance sheet runoff and resumed reserve management purchases. Maintaining policy credibility and independence is emphasized as critical. Fiscal sustainability concerns. Under current policies, general government deficits remain 7 to 8% of GDP, public debt projected to reach 140% of GDP by 2031. While sovereign stress risk is low, rising debt and short-term borrowing create increasing vulnerabilities. Distributional effects. Tax relief on tips and overtime plus higher child tax credits boost incomes. But Medicaid and food assistance cuts, combined with tariffs, reduce real incomes for the bottom third. Poverty is projected to rise. After 2029, expiration of progressive tax provisions lowers real incomes for the bottom half. IMF recommendation. A front-loaded fiscal consolidation is needed. Shift to a primary surplus of 1% of GDP, roughly a 4% of GDP fiscal adjustment, requires higher revenues and entitlement reform, Social Security and Medicare, safety net reforms to protect vulnerable households. Fiscal consolidation would also help narrow the current account deficit. Trade and external imbalances. The IMF underscores trade supports growth and resilience. Tariffs distort resource allocation and disrupt supply chains. The U.S. should work multilaterally to reduce trade distortions. The U.S. current account deficit is expected at 3.5 to 4% of GDP. The net international investment position continues to deteriorate. An abrupt portfolio shift by foreign investors poses a vulnerability. Reducing fiscal deficits and raising private savings are key to lowering risks. Financial stability. The IMF recommends full Basel III implementation, uniform regulation for banks with 100B plus in assets, stronger supervision, deposit insurance review, adjusted liquidity rules. Regulatory clarity on stablecoins and digital assets is welcomed, but integration risks must be monitored. Alternative policy mix, IMF proposal. The IMF suggests a different path to meet U.S. objectives. Permanent full expensing for corporate investment, replace tariffs with a destination-based consumption tax, skills-based immigration with higher legal inflows, savings and childcare tax incentives, entitlement reform, close tax avoidance loopholes, expand earned income tax credit, better target child tax credit. This combination would raise employment, boost growth, reduce poverty, lower trade and current account deficits, put public debt on a downward path, institutional framework. The IMF stresses the importance of preserving institutional independence, fully resourcing agencies responsible for revenue, financial oversight, and economic statistics, maintaining strong governance structures. Key projection snapshot: 2026 real GDP 2.6% annual, core PCE 2.2% in 2026, 2% by 2027, unemployment 4%, federal deficit 6% of GDP, federal debt held by public 100.7% of GDP in 2026, 109.8% by 2031, general government debt 141% of GDP by 2031. Closing frame for your video. This Article 4 makes clear the U.S. economy remains resilient, but the policy mix is shifting risks from cyclical concerns towards structural sustainability challenges, particularly debt dynamics, labor supply, and external imbalances. The IMF views near-term risks as balanced, but medium-term vulnerabilities are building.